You want to start? Good evening, everyone. I think we'll go ahead and get started. A little ahead of schedule to leave a little bit more time for great discussion that we anticipate tonight. My name is Strauss Alexander. I'm Vice President of Programs here at the Keystone Policy Center. And we want to welcome you to Summit County's best kept secret here in terms of these kinds of conversations. But we've been here in Keystone since 1975. Many of you may have known Bob Craig, who was our founder here, and I think Terry, his wife, is maybe joining us at some point. But Keystone has always been a place for people of divergent or even sometimes complementary interests to come together and explore some of the challenging issues that we face in energy, agriculture, environment, health, education policy, and try to forge better and more actionable solutions to the public policy issues that we face. For those of you who want to know a little bit more about Keystone, blue is not our favorite color. Julie's going to fix that there. Yes. We do have a workshop coming up in October, which for those of you who spend time here know is a lovely time to be in the high country, talking about the work that we do on bringing people together and on building and forging new solutions and creative problem solving. And Jonathan Gertz, who's helped with this forum tonight, is one of our leaders of that. So if you have questions, we do have brochures and they are out there. But on to the evening tonight, we're actually really honored to be in our second year of our partnership with the Global Interdependence Center and David Kotek and his staff to be able to provide a glimpse of a lot of the broader context and issues. I was just saying to David, he has a knack for getting onto the very timeliest of issues with the people he's been able to bring here to Keystone and to Summit County to share their perspectives on what's happening in the world. So Keystone Policy Center and the Global Interdependence Center have been partnering to provide these forums. We're thrilled with the turnout tonight, and if it continues to be successful, we'll do another one next summer when David's back in town. So really honored to be here. I'm going to turn it over to David to tell you more about the Global Interdependence Center and also introduce our speakers for the evening. So thank you all for coming, and if you need anything, please just let us know.
Thank you very much. We are in Silverthorne. Christine and I are in, I don't know if Christine is here right now. I can't see.
Not yet.
And not yet. Christine and I are in Silverthorne, so we have taken growing fondness to Summit County. And I just want to introduce a couple of people before we get to the program. First, the most gracious welcome that we had in Summit County are from our very dear next-door neighbors. And they are here, and I want to tell you about each of them for a minute, even though they're your neighbors too. Larry Gilliland was elected treasurer of Summit County 5 times. Now, that right away says an awful lot. And he didn't go to jail. And I'll tell you one other thing about him. Because of some family history with Mary Ellen, who I'll introduce in a second, I saw the news release when 45,000 barrels of Jim Beam bourbon burned and was lost not very long ago. So I emailed Larry and Mary Ellen with this news flash, and within 12 seconds, Larry was back with an email that said, "It's enough to make a grown man cry." Wonderful neighbors. Mary Ellen is a historian, a journalist, knows more about Summit County than a whole lot of folks, and has 16 books, and many of you have them, or have at least one of them, in your library, and she's sitting right there, and she's a marvelous writer, and any one of those hikes would be good exercise. I always take the one that's made for children. So, wonderful neighbors that are here, and we're glad you're here. Michael Drury in the back is Chairman Emeritus of the Global Interdependence Center. Came from Memphis for 12 hours or so, and has a speech tomorrow in Vail and then back to Denver Airport. Michael, we're glad you joined us. And forgive my voice, I have to also introduce Jill Fernito, who is the Executive Director of the Global Interdependence Center. The Global Interdependence Center has some information on the table. You will find us in programs of various types worldwide. All of them convened neutrally. The whole concept is you bring people of goodwill together, talk about important issues. Sometimes good things come out of it, sometimes they don't. And the coincidence of getting to Summit County and establishing summer groups gave me an opportunity to invite some friends. It's terrible. I have to house them at the house, I have to feed them, I have to take them to the fire pit, but we survive. So that's why we're able to make this wonderful partnership with the Keystone Policy Center. The broker of the partnership was Larry, who I think was on this board some time ago and involved here. But whatever, he brought us together, so we're happy to put on a conversation tonight. And Jill is the one who makes it all happen. Last announcement, we'll get to the program. One of the things the Global Interdependence Center has done in the last year is to take a delegation to Cuba. We were there in January. I co-chaired that delegation with Kathleen Stephenson, who is our program chair. This is not a tour to Cuba. It was a meeting in the central bank, with the central bank of the country. It was a meeting with the foreign ministry of the country. It was a meeting that had to do with commerce in the Caribbean, and the strange arrangement that Cuba has between the United States, Canada, the European Union, and the Caribbean countries. It's a bizarre system. At that meeting, we did not want to meet with 80-year-old, gray-haired Castro Cubans. They're still fighting the last war. And their counterparts in Miami are still fighting the same last war. So we probably met 20, 25 young, mostly English-speaking entrepreneurs in private businesses in a communist country. We had all of our meals in private restaurants in a communist country. Entrepreneurial young people. At the end of the meeting in the central bank, we started to talk about some very difficult issues for the Cubans who are the younger Cubans. They don't have banks, they don't have mortgages, they don't have any of the concepts that we take for granted. We then said our delegation would be willing to come back again if we can be helpful in a dialogue. And they immediately said, we have no one to talk to, so please come. Now, never in my years did I think I would sit across the table from the governor of the Central Bank of Cuba and have a conversation in that central bank, let alone get invited to come back. Never. Then we started to put together an agenda. The new sanctions on Cuba have caused the people who were in the federal government not to go with us to the return visit. They were with us in the first one, but they're not permitted to go. And a number of major public companies in the United States are now afraid and have said no to some of their delegates coming with us. So we have a delegation going to Cuba, and it has a few empty seats. And we're leaving on the 17th of November from Miami, and we will meet with the central bank and the health ministry, talk about preventive medicine, foreign policy. We have a meeting in Sarasota, Florida on the 15th of November, and that will include the Central Bank of Mexico, of Spain, the Federal Reserve, and the Director General of the Caribbean Nation commercial structure, and then we'll go. And at the end of the week, on Friday, for those who want to stay, we will go to the Bay of Pigs, and at the Bay of Pigs, interview one of the survivors of the Bay of Pigs battle 58 years ago. At the Bay of Pigs, the museum, and then come back. There are seats in this delegation that otherwise would not be available. Jill Fernito has all of the information. There's a flyer on the whole thing that we wrote. So what GIC has done last week in Idaho and in Wyoming and here is say to partner organizations, we've got an empty seat. It's silly not to have someone who wants to use it. Anybody here who's interested, please talk to Jill and we'll get you all the information. Okay, we have a great program tonight. Are there bios?
They're on the agenda.
The bios are out there? Okay. So here's what we're going to do tonight. We have Bill Strauss from the Chicago Fed for half an hour, Bob Bunting from the Climate Adaptation Center, and also, by the way, a migrant between Dillon and Sarasota, Florida, as am I. And then we'll have some Q&A, and we'll be done with a hard stop at 6:45 plus or minus a few minutes. A word about Bill Strauss, since he's going to go first. I've known Bill Strauss for years. We were on several organizational structures together. He's a member of the Global Interdependent Center Advisory Board. There are 4 from the Federal Reserve on our advisory board, I think. He has you may not know him, but he has a distinguished career in the Central Bank of the United States. He's been at the Chicago Fed almost 4 decades. And his expertise is macroeconomics of the U.S. economy and specifically the manufacturing sector. There is a little ripple of discussion these days about the U.S. manufacturing sector. So Bill has a presentation. After Bill will come Bob, and then we'll do the Q&A at the end. Bill Strauss, please go.
Thank you, David, and thank you for the hospitality that you and Christine, who came in the back of the room, has offered us. It's been a wonderful stay out here. And he forgot to mention that he actually served some really nice wine.
But no bourbon.
No bourbon, but that's we're still not out of here yet. But hopefully all of you tonight maybe will imbibe in a glass of wine, because there is something to celebrate this month. Sure, we're a week away from celebrating the 50th anniversary of Apollo 11 landing on the moon. We're just a couple of weeks away from the 50th anniversary of Elvis starting his Las Vegas run that went all the way through '77. But really what I wanted to have us celebrate is the fact that last month we tied the record in terms of the duration of expansion, which is now at 120 consecutive months of growth. So as we have entered into July, and the best sense we can have even with activity now, it seems like we're still growing. So we are now setting a new record with regard to the duration. And by the way, the last duration was for the record expansion took place in the 1990s. Kind of proud to say that since I've been with the Fed, 90% of the time we've been in expansion. So let's hope when I retire sometime in the near future that continues to do well. No promises though, I won't be there. So what I wanted to do is kind of cover where we are with regard to this record expansion. In part, given the duration, a lot of people think that Well, since World War II, our expansions have lasted on average about 5 years, so we're due for a downturn. Now that this one is twice as long as the typical expansion. But that is not how expansions end. There's nothing that I share with people that make them feel so good that they really don't want to make any more money. They just want to put their feet up on their desk and just chill. That's not how activity happens. We grow. We grow by what is considered the trend growth for the U.S. economy. By trend growth, it's based upon the two ways any economy can grow. The first way is labor force growth. Labor force growth in the United States, based upon population growth, immigration, it's about 0.7 to 0.8% per year. So with 0.7 to 0.8% more people to do the work of the economy, our economic pie rises by that amount. But it does not improve living standards because while the economy is that much larger, 0.7, 0.8% larger, you got 0.7 to 0.8% more people that want their slice of that pie. And we know living standards have improved, so that occurs through the second way of growing an economy, which is doing things more efficiently, more effectively, what we call in economics, productivity, which is regarded as having a trend of around 1 to 1.25%. So adding those two growth rates together, we come up with what is regarded as the underlying trend for the U.S. economy, about 1.8 to 2%. So when the economy is growing at around 2%, that is something not necessarily to celebrate. I guess it's better than going down, yes, from that standpoint. But it really is just being the U.S. We're not being exceptional. Now, last year, we did have exceptional growth. Last year's growth came in at 3.2%. In fact, first quarter had that same growth trend of roughly 3.2%. We don't have second quarter data yet. We'll get that for GDP in a couple of weeks. That's one of the problems with GDP is there's quite a bit of a lag in getting information. So for GDP, we only have data through March. I've got other data to kind of support what's been going on. So growth rates have been well above trend. So that certainly has been very positive. But we produce something at the Chicago Fed known as a National Activity Index. It's a higher frequency. In fact, we have data through May represented up here. So we already have 2 out of the 3 months of the second quarter reflected. So we have a pretty good sense of what that might be showing. The way to interpret this is when we are at this black line of 0, it means that the U.S. economy is growing at a trend rate of growth. When we're going above it, as we were for a good part of last year, we're doing better than trend. But as you can see, as we came into 2019, activity has absolutely gone below 0. So we're looking at an economy that, at best guess right now, is kind of operating below that trend rate of growth. Now, it doesn't mean we're in a recession, but it does mean that we're, again, not achieving our potential growth that we should accomplish. But it does suggest that we need to be cautious about a recession. In fact, when our indicator has historically gone into the, about minus 0.7 to a minus 1.3, the shaded area I just added, that's an area where it coincides with one of these gray shaded areas of recession. So the good news is that while kind of weakened in April, it actually bounced up a little bit in May. So risk of recession is very reduced for the United States. We're not kicking butt like we were doing last year, but again, we're not really super weak. I think the stock market's reflecting that. We're at all-time record highs. There was a bit of nervousness as the market lost 20% of its value in the fourth quarter of last year. My take on that was a lot of that was driven not by things happening in the United States, but a realization as the OECD, the IMF, the World Bank, in the fourth quarter of last year, began to announce much reduced growth in other parts of the world. And, you know, I talk about Elvis in Vegas, you know, that expression, what happens in Vegas stays in Vegas, so not with the iPhone, first of all. But more importantly, what happens in the rest of the world does not prevent us from being impacted by that. So that was part of it. And by the way, I think you can kind of see that linkage because simultaneously with the reduction of equity prices in the fourth quarter of last year, we saw energy prices move down quite markedly. And basically they went hand in hand. And I think, again, the view was, if demand is going to be that much weaker for growth around the world, we won't be needing that much oil as we previously had thought. So the price weakened. The good news is that it bounced back earlier this year, and we're again close to record highs with regards to the price of the equities. So the timing is good. We do have an FOMC meeting coming up in a couple of weeks, but we did have one in June, and the June is actually a more special one compared to the one that's coming up in July, because every other meeting, the Fed puts out what is known as the Summary of Economic Projections. It's an opportunity to share among the 17 policymakers who currently serve on the Federal Market Committee what their views are on key economic data. Real GDP, the unemployment rate, a couple of measurements of inflation, as well as the main policy tool, the federal funds rate. And I'll be presenting all of those on charts. So here we are looking at what their predictions are in June, so just less than a month ago, or roughly a month ago, with regard to what they are seeing for growth for the U.S. economy. And we go out not just to this year or next year, we're going all the way out to 2021. In part because of the long lags of policy, we need to be thinking well beyond what's right in front of us. But that being said, the Fed is saying, okay, yeah, we had exceptional growth, in the first quarter and fourth quarter of last year, but what's expected is a significant weakening as we get second quarter data, third quarter, and fourth quarter. Growth continues, but we should be anticipating growth that is actually much closer to what's regarded as trend growth, maybe just a hair above it for this year. And for next year and the year after, similar kind of growth, kind of, I would even say statistically not that different, but it's a little softer than even what's expected this year. In the long run, that's the 1.8 to 2%. That's the blue shaded box I have up there. So you can kind of see that the Fed is saying it's going to be growth, but nothing to write home about. Growth that we should be expecting the economy to perform at. So some indicators with regard to, again, whether we should be nervous about a recession. There's a group called the Conference Board, and they put together 10 different economic series that have what is referred to as leading properties. They tend to move ahead of the overall economy. Many of these come out of the manufacturing sector. For example, they look at hours worked in manufacturing. They look at new orders being placed. When you place a new order, that's in anticipation of something you're going to want in the future. So they have this kind of forward-looking sense of activity. And as you can see, historically, it tends to start to fall ahead of one of those recessionary periods. So you can see that this year, we have data through May for this series, has been flat, edging higher, just barely ticking higher, but for the most part, we can call it flat. So, and I think that's reflective of this economy, which appears to have hit the brakes a bit. I should have also mentioned that probably what we're really dealing with this year is a lot of the uncertainty surrounding the trade story that's going on. The issues surrounding what's going on with Mexico, one of our main trading partners, China, again, one of our main trading partners. And it's the uncertainty, I think, that has put a pause on business decisions that probably is having an undue influence with regard to some of this. Labor markets continue to remain strong. I don't want to use hot. I heard, actually we were up in Victor, Idaho, with Tom Barkin from the Richmond Fed, president of the Richmond Fed, and he was saying that he is really hesitant to refer to the labor market, even with a 3.7% unemployment rate, as being hot, in part because we're still adding a lot of workers and wages are not rising very rapidly. You'll see some of those charts. So, but it's been a very solid performer. And the way you should be thinking about this is every month that we're adding these workers is a really good thing, because that is more people who are getting paychecks, more income that is being generated by these individuals, and that helps support the growth of the economy. The 2.3 million is well above what is the underlying growth of the labor force. I mentioned about 0.7 to 0.8%. You can see that we're basically double that with regard to this growth. So this has been a really exceptional performing part of the U.S. economy. And I will say probably one that if you kind of sat an economist down and tried to ask them, how is this still possible to be adding this many workers when we have an unemployment rate of 3.7%? I think a lot of them would be kind of scratching their heads a bit to really explain what is happening, but nonetheless, it's a very good thing. So the unemployment rate has come in very low. And in fact, the outlook from the Federal Open Market Committee is that they are willing to allow the unemployment rate to remain low. The natural rate is regarded as between 4 to 4.4%. That's the box right here. And as you can see, policymakers, the typical one, that's what the red diamond is, it's the median forecast, is saying those unemployment rates all the way through 2021 stay below even the bottom of that natural rate. Now, I've been at the bank for 38 years, and I'll tell you, this is really unusual. Because when the unemployment rates are this low and below what the Fed regards as the natural rate, you begin to worry about inflationary pressures. The story is that workers being in tight demand will see wages that begin to rise as firms are trying desperately to find those qualified workers they need, and they start a bidding war to get those workers. And of course, then they have to pass that additional cost on to the price of the goods they produce, and you get this cost-push inflation generated by the tight labor markets. The Fed is saying, you know, we're going to let this remain quite high. Because, I mean, we wanted to, we can just raise interest rates up quite a bit, slow the economy down, and the unemployment rate will go back up, and then there goes the loss of the fears of inflation. But the Fed is saying, no, we can tolerate this. And I'll explain probably what the Fed, certainly what I'm thinking, and certainly probably what the Fed policymakers are also thinking. Because in fact, wages have not done great. This is the wage and salary growth from the Employment Cost Index, data through the first quarter. And you can see that it has been improving, yes, but still in the first quarter of this year, it was around 3%. And you're like, 3% is not a bad increase. Keep in mind this is nominal. Knock out the inflation that we're getting, and you can see that this has not been an impressive performance. And here's your benefit costs. This would include medical as well as any additional benefits that are received, bonuses and so forth. It's not good. It's not rising very rapidly. In fact, one of our colleagues, Bill Dunkelberg, is the chief economist for the National Federation of Independent Businesses, and Bill does a survey each month of his membership, and one of his questions is, do you plan on increasing workers' compensation? So it's a forward-looking statement, and with a 9-month lead, you can see that it generally lines up very nicely with the wage and salary component for private workers. It had a break over here a little over 10 years ago, but when it corrected, it was by having the wages go up to the point where they were talking. It wasn't that they had to change their tune, they just still really were back behind what they were saying. They weren't backing it up right away. We have a very similar situation right now, where looking at this correlation, which has an 83% correlation, we should be looking at closer to 4% gains. And I think that's where we're heading. Would not surprise me that a year from now, we're looking at 4% gains for the American worker, which is all in all a very good thing. Because there has been a shift away from the wage component, wage and salary component, to the capital side of the economy for a very long period of time. And you know, when you think about the fact that a very large share of American workers are not tied to the equity markets. So if you have investments, as probably most of you do, you're probably feeling pretty good for the last 10 years. If you have a job still, maybe your salary isn't rising very rapidly, but the other parts of your investments are doing quite well, making you feeling pretty good. But keep in mind that about 40% of American households could not come up with a $400 to meet an emergency expense. They have to sell something at a pawnbroker, for example, in order to do that. So most Americans are not in that same kind of position. They rely upon their wage. So it's been a challenge for them. Why has it been a challenge? I think we're back to the Great Recession, where 8.7 million workers lost their jobs, workers were plentiful, it wasn't until 2014, because of the fact that while we have this long duration of growth, it's not been impressive growth. It's been the slowest expansion since the Great Depression, just averaging 2.3%, barely over trend. So in that context, it wasn't until 2014 that we got back those 8.7 million jobs. But that also ignores the fact that our labor force is growing every single month. And we should be generating about 80, 90,000 jobs a month to make sure that those new entrants get jobs. And it wasn't until this year that we got to that point where we're kind of now in a neutral stance. That's an awful long time, nearly 9.5 years, to wait to get recovered from the last recession. With that in mind, workers were being utilized a lot more than capital. And so productivity suffered. And as I mentioned, we think productivity should average around 1 to 1.25%. It averaged on a 5-year moving average, so what we have here is actually reflecting almost about 9 years worth of data of sub 1%. And ultimately, productivity generates standards of living. And that's why the real wage gains have not materialized. The good news is, of late, that has come back. Why? Because investment, which is a key driver, was weakening throughout the expansion to the point that in 2016, we actually saw a decline. The good news is, since that point, investment has come back with some gusto. And I think that is fostering some additional productivity of the U.S. workers. So if I talk about workers getting an extra 1% compensation, but let's say productivity is generating an extra 2%, it's actually costing businesses less to have those workers, not more. They can afford to pay those workers that additional amount without having inflationary consequences. In fact, we have a measurement of that called unit labor cost. And if we're about to go into a wage cost spiral, one would think, oh, of course, productivity is going up finally. One would think that this indicator would begin to skyrocket, much like if you remember the 70s, we were in one of those wage cost spirals. In fact, with the most recent reading, it's negative. Workers are costing businesses less in the first quarter of this year than they were a year earlier, with respect to productivity gains as well as the wage gains. So I think that is why the Fed is somewhat sanguine with regard to the unemployment rates. And profits, we had a down quarter in the first quarter, but still year over year positive. The fact that the equity markets are still up high, I think, again, that certainly protects profits as well, if you're having to not have to sacrifice profits to pay the workers out of profits that is being made up of productivity. Inflation, my bank president, Charlie Evans, was on CNBC today. Some of you might have seen him. And basically his thoughts are that the Fed wants a 2%. We have a 2% target. We've been underrunning it for a very long time. We briefly got above it last year, but again, with that collapse of energy prices and other things, we saw it weaken quite a bit. And if we're sincere and serious about this, his view is that we should be reacting to get it up. Here's the energy price move lower that occurred in the fourth quarter. Kind of came back up, still remains a bit low. On a spending by consumers, it's really not an issue. This is the spend by consumers for filling up their vehicles, paying electric bills, heating bills, anything directly related. It's a little over 4 cents out of every dollar they spend. From a historical perspective, this is really low. Going back to 1960, it averaged over 6%, or over 6 cents. And as you can see, these red lines are decade averages, so here's the decade we're in. It's the lowest decade that we've seen since the 1960s. And in fact, where we currently are is well below what we've averaged this decade. So energy, fuel is really inexpensive. And that's why, the big selling vehicles are these SUVs and everything. Everybody, they don't care about the price of, or the MPG. And again, this is probably what Evans is probably concerned about, is the fact that even moving food and energy prices, the core rate of inflation remains quite weak. And if we're truly talking about 2%, there's something that should move that higher. What the Fed is thinking is that for the top line inflation measurement, it's going to remain roughly where it is this year. But as the economy continues to tighten with regard to the labor markets and some of those other issues, we'll see it getting closer to our 2% target. The same is true for the underlying rate of inflation. So, inflation really not getting out of hand. I should have asked, so these charts can be made available to the JC website. These will be on the Global Interdependence Center website, so I apologize. I hate putting up a chart like this with lots of numbers because I'm just going to blow right through it. What you want to do is, this is July 10th latest outlook from the Blue Chip Forecast Group. These are 50 non-Fed forecasters, and it really reflects that point I made earlier about the view of growth around the world. Because, if you're talking about pressures or inflationary pressures in particular, it might be like, well, you're not seeing them domestically here, but you might import it as some other part of the world is going too hot. Well, as you go through that, you can see that nobody is setting their economy on fire. Everything seems to be quite muted. In fact, I would arguably make the point that the U.S. has the strongest economy in the world. And you can kind of see that reflected here. I apologize, this doesn't look very good. It will look good on the GIC website because the green and the yellow are kind of blending, but this is actually yellow. The globe went into a yellow position, or a flat position, this year. And really, all of this you see here, while it looks green, is actually yellow. It's flat. And the same is true for the United States and the NAFTA region, but we have been the relative strongest. Sorry, we'll keep moving on. The housing market continuing to edge higher. Certainly the lower interest rates that we've seen is probably inducing some activity to occur, but Blue Chip is thinking about 1.2 to 1.3 million housing starts. We have some people on our groups that are much more of housing experts. Their view is still that about 1.5 million is like a normal year. So even next year is viewed as being subpar for the housing industry. The industrial side, growing relatively flat is the current view by Blue Chip, 0.2%, which when you think about the fact that the manufacturing sector hit a road bump in the first half of this year with 2 down quarters. We just got the industrial production report. We had gains in May and June, that's true, but still for the quarter it was down somewhat. Their expectation is that the rest of the year we see growth coming back, in fact offsetting the weakness in the first half so that it nudges out a gain, but let's call it flat. So a flat year, by the way, after having a spectacular year last year. How is that possible? Again, I think it's a trade story that has really impacted this business cycle. Next year, 1.4% is still, all in all, quite muted for that. Last couple of slides. If you're looking at the financial markets and trying to get information out of them, one thing I look towards them for is the risk of recession. And I use this chart to kind of nudge that out of the financial markets. This is the corporate bond market and 2 different players. So it's called the yield, it's called the yield curve. But it's the difference between two particular borrowers, or credit spreads. High yield, so high yield it's a marketing term. You know what high yield bonds are? What's the other word we use? Junk. But we call them junk, people wouldn't buy them. But we call them high yield because they have to offer a higher interest rate. Compared to AAA, so it's basically AAA rated companies versus the companies that are on potentially the verge of bankruptcy. Why is this important? Because if you think we're about to go into a recession, you worry more about the risky borrowers, and you tend to charge them more for that risk. And you can see that happening as we went into the Great Recession. Here was some concern when the U.S. government had its rating downgraded from AAA to AA+. Here was the turmoil in the Middle East. All of it kind of came down and flattened out impressively low. Here was the fourth quarter of last year with a 20% collapse of the equity markets. It made this market a bit nervous, but it never got up all in all quite high. And as those equity markets recovered, that risk came back down and remains, from a historical standpoint, quite muted. So I look at this and I say, these players are not very nervous. And it's one thing to have blue chip talk to you about stuff. This is the Las Vegas of information, because these are not just, when I go to Vegas, I don't gamble, I know the odds, but I'll watch, the action on a craps table. I'm standing and maybe I'm making a guess of what the next roll will be. But this market are the players at the table. So they're vested, they're putting bets down. So, again, a lot of value to that. And they're saying, I'm not worried about a recession. The thing that might cause you a bit of pause is the fact that the yield curve has inverted. This is the difference between 3-month, which is kind of often viewed as a policy rate, since it's getting awfully close to the federal funds rate, which is an overnight rate, versus a 10-year rate. And you can see that when it inverts, it is often followed sometime later by a recession. So as it inverted in June, it made some people very nervous. So the blue chip offers up, unfortunately I can't share with you my outlook for neither the 3-month nor the 10-year. The Fed doesn't do that. But blue chip does. That's why I use these two. And when the July 10th came out from blue chip, the very first thing I wanted to see was, what is their view with regard to the rest of the outlook for the yield curve? And I took some confidence out of this that you would be hard pressed if this is what materializes to make a claim that the yield curve is talking about a recession, because the amount of decline both in the first and second quarter and what's anticipated in the third quarter is really infinitesimal. And what we see is that later in the year, fourth quarter, we actually start seeing the yield curve steepen somewhat. Finally, the Fed policy. This one is a little tougher to explain, and it's one of the problems when you're grabbing the midpoint. And what we see here is the Fed is saying no interest rate change this year, but then it goes down next year. I don't know what would cause the Fed to go down next year, or what they see. I don't see anything on the horizon that would kind of explain it. And that's where I think there's some value to actually looking at the central tendency. So this is where the typical, or the majority of the policymakers are residing, and basically they're all between 1.9 and 2.4, last year at 2.6, all the way through the next 3 years, 2.5 years. So it's basically, the way to interpret this is they were saying at that moment in June, they see little reason to change interest rates as we go forward. Now, of course, during Chairman Powell's testimony, he seemed to be very dovish. Certainly the market interpreted that and saying the probability of a rate cut at the next FOMC meeting in a couple of weeks was at 100%. There's been some better news that has come out. Again, the industrial production was a decent report this morning. We'll interpret all that data and we'll have to see what we ultimately do. But all in all, I would say it's a decent outlook, not impressive, but the expectations are that we're going to see growth continuing all the way through 2021, establishing a real long duration. And I think part of the duration is the fact that it has been mild. I will refer to this as the tortoise economy. It's been moderate and steady growth. What that means is we've not had an industry, and I defy you to tell me any particular sector outside of maybe the financial markets, which has jackrabbited ahead. For example, at the last expansion, we had the housing sector that went from typically averaging about 4.5% of GDP, surging up to 6% share of GDP. The technical term we use in economics is it went nuts. And when it corrected, the bubble burst, it took down not just the housing sector, but all of the financial markets that were very much tied in and supporting that kind of activity. I look around the real side of the economy, and I see plenty of room. Plenty might be too strong a word, but I certainly see room in almost every industry for additional growth without causing us to be in constrained position. And I don't see any sector that has gotten too hot. So with that, concluding points, and I look forward to any questions that you might have. Thank you.
An economic tour de force in 27 minutes. Now you know why in the Federal Reserve there are the group that sits at the FOMC, and behind each of them there's a consigliere. And those are the folks put together the advice to those who are going to go to a meeting and vote. Sometimes they go to those meetings and make presentations to them. And so it's a real treat to have one of them sit with us.
These are also put up here. If you're looking for the Chicago Fed National Activity Index, you'll find that at chicagofed.org. And anything on that summary of economic projections, federalreserve.gov. Thank you.
Interdependence.org for the slides and the presentation. We'll do the next presentation, Bob Bunting, and then have a little Q&A before we wrap things up. Now,